providing some value. So appreciate you tuning in. I'm super excited about this week's topic. We are talking about cost segregation, which allows you to really maximize what I would say one of the most powerful tax benefits of real estate, and that's the depreciation. So a few months back, we actually had a fellow attendee here, Justin Jensen, who's a real estate centered CPA, talking about some of the tax benefits, and he touched on the cost segregation. Tyler, his company, focuses exclusively on generating these reports that are then delivered to your CPA like Justin so that they can input it into your taxes so you can really maximize that potential. So super powerful tool, a big reason why a lot of people choose investment real estate. So really excited to get into it. As we're going through, traditionally, if this is your first time tuning in, we ask just you put questions into the chat box, and then we'll address those as there's appropriate times in the conversation. And Tyler, as you're going through your presentation, if you're getting ready to change topics or shift a little bit, let's always take a minute to open it up to see if anyone has questions at that time. So
sure, feel free to interrupt me at any point. I talk a mile in a minute, so.
Awesome. And Justin, we might put you on the spot as well, since we have your expertise on the call with us, because these things really go hand in hand. So we definitely have a wealth of knowledge on this call today. So excited to get started. So Tyler, welcome. Appreciate you being on. Why don't you start by sharing with us a little bit about who you are and what you do and what the heck cost segregation is?
Yeah, thank you so very much. I appreciate it. So cost segregation is, I always say, the only guarantee in the world of real estate, right? It's the only thing you can guarantee that you're about to make some money on is cost segregation. Goldman Sachs, I think they just came out. I don't know if you guys saw that new report where they just changed their minds on the forecast for 2023. Originally, they were pretty dismal. They're like, hey, the market might dip 15-20%. Now they're like, hey, the market might only dip like 3%. Nobody really can really guarantee what's going to happen in the future of real estate. However, I can guarantee that if you use a cost segregation study, we can keep you from paying taxes or giving Uncle Sam some of your hard-earned money. Now I'm going to share my screen real quick here and walk you through. Start broadcast. 3, 2, 1. And we should get this. There we go. All right. So if everybody can see that, we're talking cost segregation. My company that I am with is Madison Specs. This is, in my opinion, the most influential cost segregation firm in the country. These guys have been around for years, long before this became a big kind of topic over the last 4 or 5 years where everybody's been talking about it. They've been around really since the beginning, and they have the expertise to prove that. And a client list that's as impressive. They just crossed $4 billion in depreciation. I am Tyler Baldwin. So I'm the regional manager. I live in Phoenix, Arizona. I focus heavily in Southern California, Texas, New Mexico, Vegas. However, tons of clients, because you guys know how real estate works. You could live in Phoenix or live in LA and you have buying property in Florida. I have a lot of clients that are buying property in Florida, a lot of clients who live in Florida buying property in the Rust Belt area. So a lot of people in Washington, Seattle area buying property. So I cover the whole country. I'm a former news anchor. So I spent most of my life as an Emmy-winning news anchor. In fact, that picture is from the Waste Management Open a couple of years back. And if I was currently still employed, I would be upside down and on my head with the Super Bowl weekend here, covering Waste Management Open, out there every morning at like 5 a.m. You don't get home until 1 o'clock in the morning and you hit repeat. It's crazy. It's a wild time. My phone number is also on the screen, 602-349-2232. Do not hesitate to text or call at any point if you have any questions. Some people like to call and ask for some estimates on cost segregation studies once they've closed the deal. I have a lot of clients that actually, when they get kind of early on, they're penciling a deal. Sometimes they get close, they might actually call me up and say, hey, how does this going to look cost segregation wise for my potential investors? What are some of the numbers I could use to show investors when I get this thing going? So it doesn't matter what stage you really are when you're buying real estate, just hit me up and I can put together a free cost seg estimate. So if you like what you see, don't hesitate to reach out. Let's start at the beginning. in Genesis. What is cost seg, as the kids like to call it, or cost segregation? It's really a tax planning strategy that really shelters taxable income by depreciating certain components of a property at a faster rate. What does that mean? That means if, let's say, you bought one of the townhouses in the picture there and you were Airbnb-ing it this weekend for the Super Bowl and making $1,500 a night. Normally, if you bought a $500,000 property in Glendale, you would take the land value out, leaving you with about $400,000, and then you would divide that up among 39 years. It's 27 and a half for multifamily or residential, but 39 year for Airbnb commercial. So you would divide that up among 39 years. So you get a write-off of about $10,000, which probably wouldn't even cover the profit you're going to make this week with your Airbnb in Phoenix. So what you could do is segregate out the various costs with the use of an engineering firm like Madison Specs, and they take each little aspect of that building, the windows, the doorknobs, the landscaping, those trees in the front. They take every little detail of that building and they drop them in the faster depreciable buckets, things like 5 years, sometimes 7 years, 15 years, and then they leave the bulk of the building, the roof, the walls, etc. They'll leave that stuff in 39 years. But then they take the 2017 tax law and they're allowed to take anything under 20 years and bonus it into the first year. So you end up taking, let's say, 25% of that, about 100 grand of write-off in the first year instead of just 10 grand. Cost seg's been around a long time. Okay, taxes itself, just over 100 years old. I mean, they had it in the Civil War, but it really got going in 1913, and it did not take long for people to start arguing about depreciating their assets. In 1962, cost seg became a thing with the ITC. They tried to phase it out in the 80s, but it was defended in court in 1997, and cost segregation was back and running again. People talk about it. I've got clients, man. I've got clients that will call me and be like, man, I have been in commercial real estate for 30 years, and I just found out about this yesterday. And they think it's a lie. They think I'm making stuff up, but cost segregation has been around a long time. It just really got put on steroids in 2017 in the Tax Cuts and Jobs Act, which said when you put those faster depreciable buckets down, we're going to bonus it all into the first year. So why use a cost seg study? Obviously, bonus depreciation is amazing. Taking a huge, massive write-off right up at the top is very important. You can use that to reduce your tax liability. And then you take all that money you're supposed to give Uncle Sam. And I had a client the other day who was like, I don't know if I should do this. And his write-off was $1 million. And he ended up doing it. And I was like, now here's my advice. You can take that money that you're about to not pay Uncle Sam and you can go buy jet skis and party. But the better idea is to take all that money and go buy more property. Use that cash for when this market starts to look real sexy here in the next couple of months. You can be a little more liquid with that 2022 tax, receipt that you put in, that tax return, and you got plenty of liquid cash ready to go for some more purchasing power here in 2023. What am I talking about when I say these faster buckets? Like, what does that really mean? Okay, so what that is we're talking like everything in the building gets segregated out. For 5-year property, that means things like mirrors, carpeting, ceiling fans, vinyl floors, dryer vents, the closet shelving, the signage on the front. When you guys go and get the new sign in front of a multifamily because you're trying to do a big add value to this property and you change the signage up, we can write off the sign you throw in the trash, and then we can take the new sign that you put on that building and you can write that off and bonus it in the first year. Kitchen appliances, all that stuff goes in 5-year property. 7-year property, it's not on the list here. That's usually stuff like manufacturing, machine type stuff. We do come across that, not a lot in multifamily or residential, but we do see it. 15-year property, that's stuff like the asphalt, the sidewalks, fencing, landscaping. Even we get so down and dirty, we literally will write off the pavement markings. When you guys paint the little marks for where people can park in your 16-unit apartment complex, we're going to write that stuff off as well. Here's an example of what that means for you. So if you were to purchase an amazing, let's say 10 unit property for 1.8 million, which would be a steal in Phoenix right now, I feel like, if you were to have bought that in December of 2022, the first thing we do is we take out the land value. We don't get to depreciate the dirt, but we're going to take out that land value of, say, about 300,000, leaves us with about a $1.5 million property, which if this was a multifamily, we would then depreciate that over 27 and a half years. We just divide 1.5 million, get 27 and a half years. Instead, we segregate out all that 5, 7, and 15-year property, and then we take all that in those faster buckets. And instead of putting it in 5 and 15, boom, we just take it in the first year, which in the case of this example, it's about a $426,000 write-off. Now, why is that really significant? Because what did you put down on a $1.8 million property? I mean, if you went and put down like $350K on a $1.8 million property and you got a bonus depreciation of $400,000, that means you get to go to your investors. If you're in syndication, you get to go to these guys and say, hey, not only if you give me $100,000 to buy this property, are you going to see, dividends, passive income as this thing begins to bring in cash flow, but also when we sell it, you might even make maybe 2x on the property on the exit strategy. However, rather than just waiting for all of that stuff to cash flow and waiting for the big sale at the end, from day one, we're going to get you a write-off for more than the money you give us. Sometimes we're literally going to give me 100,000. I might get you a write-off for about 100,000. It's pretty amazing. So the big question is not why you should do cost seg. You should do cost seg. The question would be, why would you choose a company like Madison Specs? This is, in my opinion, the best company in the nation. They literally are giving an average of $275,000 per property that comes in. They've got 100 years of combined industry experience among the people that work there. They've got 800 employees total, 16 in-house engineers. You want to make sure the company you're going to pick has an in-house engineer and a lot of in-house CPAs there. And the reason for that is if there's a potential audit. Now, audits are very rare, okay? It is not a red flag situation. I can't tell you the number of times I've had clients come to me scared because I have somehow met them and they didn't know what cost seg is, and I now explain to them that we're going to be sheltering. I have a client that when I met him and his 3 brothers each were paying a tax bill of $1 million a year each. So $4 million in taxes sent to the IRS every year. We got that to 0. And they were nervous that they were going to get audited and they would go to prison. And I was explaining to him, look, it's not a red flag situation. This is super well defended. And if you are, God forbid, audited 6 years from now, you want to make sure you have a company that's going to be there 6 years from now. Madison Specs has been around for decades. They're going to be here if you were to get an audit, and they're going to defend you for free. They've got the experience. They've also, get those studies done on time.
Real quick, Tyler.
Yeah.
On that note, folks, this isn't a loophole, right? This is written into this is the IRS is allowing this. It's in the tax code. You can enable it. It's not a loophole. You're not doing anything unethical or shady. This is in the tax code. It's a benefit that's there for real estate investors, because if you can save that $1 million rather than paying it to the IRS, they know that as private real estate professionals, we will likely handle and reinvest that better than they could. And so they give us this incentive to reinvest it, to put it into another property. So just keep that in mind. But at the same time, they're not going to go out and openly publicize this, because they would much rather take that $1 million a year for people, right? So it's just, you don't know what you don't know. And that's why we do these webinars. That's why we bring people in like Tyler to talk about these options that make real estate investing so powerful.
Yeah, when I first started, I had that awful habit. When I first started into this industry, 4 or 5 years now, back in 2017, I used to always say loophole. This is an incredible tax loophole. And I would get slapped on the wrist because people go, it is tax law. And there's a reason they keep putting it back into the system. And that is because, I mean, and we're talking both sides of the aisle. A lot of people talk, oh my gosh, this was incredible because of Trump, but we'll never see this again. Bonus. Obama put 100% bonus depreciation in 2013. We're in this unfortunate situation now where it's starting to sunset, and I haven't got into that yet. I'm going to get into that in a minute, where it's starting to decline a little bit from the 100% bonus. However, I wouldn't be surprised if in, say, 2025, we get back. I'm going to get us be back into the camera here. I think in 2025, if they don't start to bump this thing back up, to 100% again, because it'll spur the economy again. They know for a fact that when a real estate investor goes and buys a piece of property, they have now added tax revenue to the broker, to the mortgage company, to the contractors they're going to hire to do add value, to the landscapers that are doing the property, to the improvement of the housing for the people who are going to move into these homes, to give them, like if you look in places like California where they're desperate for multifamily operators to get more multifamily for these people to rent. They know that they're just spurring the economy on. So they don't mind if you get a big tax deduction, which is why you should get it. You mentioned it earlier. One of the biggest benefits of cost segregation is when you look at a W-2 job, let's say you were a nurse and you're a W-2 job and you're making $100,000 a year in the medical field, you're paying taxes on that 100,000. That's really only like 60 or 70,000. When you make 100,000 in real estate, bro, you just made $100,000 in real estate. Like you're not paying taxes on that money. And I can get into a little bit more of that now, but I saw a question pop up if we want to take a pause real quick and answer that. Let me see.
Looks like there was a couple of comments there, which I think are excellent. So Justin, if you wouldn't mind expanding a little bit more on your comment, and then Bruce, if you'd like to as well, I think that would be very beneficial for the group.
Yeah, absolutely. And I don't want to take away from anything Tyler's saying. I'm trying to just contribute and add to, and really, I love what you're saying. It's right on. I have the same conversations, Tyler, where someone says, oh, well, that was all just loopholes and people aren't paying tax because of the loopholes. And I have to explain, they're not loopholes. Loopholes are unintended consequences that Congress did not mean for that to happen, and somebody found a way, and those get plugged. They also say that the good accountants know the loopholes and the great accountants have loopholes named after them. And no, I don't have any yet, but I'm working on it. But no, the point is that you're exactly right. Like the defensible position of a cost segregation study is because that was written by design. You are supposed to take that, which is why when you do the adjustment for depreciation, and I don't mean to get into the nitty-gritty accounting side, Tyler, I'm sure you're familiar. When you do a cost segregation study to catch up on the depreciation that was missed previously, that's why the IRS allows that to be an automatic adjustment, because that's how you were supposed to do it all the while.
Yep. File at 3115 and play catch up.
Yep.
And another great example that shows you how it's supposed to be done. Let's say you bought a house and you're doing a monthly rental for this property, okay? And you replace the roof on it. Most people, not a CPA like yourself, but most not real estate oriented CPAs might just go, here's my house on 27 and a half year. Let's just add the $30,000 you spent on roof. Well, now, according to the IRS, you got two roofs that you're depreciating moving forward. So what you should have is, if you had a cost seg study, you'd have a value for that roof. You'd fully dispose of it, drop in your new value, and then drop your roof going forward. And that's technically how you're supposed to do it. And it gives you a bigger write-off. The thing I had talked about earlier was bonus. At 2022, which that example I used with the $400,000 write-off was 2022 for a reason. That is unfortunately the last year of the 100% bonus. We are now sunsetting bonus depreciation away. In 2023, if you buy a property, you take 80% of the 5 and 15-year assets and move that to the front. Now, that means something pretty cool. You do leave 20% of that bonus in the 5 and the 15-year stuff. So what that means is, if you're getting, like, let's say in that example of an Airbnb being $10,000 a year for a write-off, what you do is you take a bonus of, let's say, $80,000 year one. Then you, for the next 5 years, get a still write off about $10,000, $11,000. Then that might drop to about $9,000. And then you move down to $6,000 for the final, couple of decades, which I always say, better to have money now than money in 2062 when you're trying to write stuff off. And a great example is because not every CPA is real estate minded. When I first got into this industry, I thought this is going to be so easy. Cost seg, I'm going to go talk to CPAs and I'm going to say, hey, send me your clients. Let's get some cost segs going. This is going to be amazing. And about half of them would be like, no, they'll get the depreciation anyway. They're going to they don't need to spend $4,000 on a study. They're going to get depreciation anyway. And I once had a CPA, one of my favorite calls ever. A CPA called me furious. We had just set up 3 cost segs for one of his clients. And these were multi-million dollars. So we're talking about $2-3 million of write-offs. The cost was about $25,000. So $25,000, $3 million in write-offs. This guy's going to avoid $800,000 in taxes, something crazy. The CPA called me furious. It was like, how dare you charge my client $25,000 and steal his money just so he can get the depreciation he would have got anyway. And I was trying to walk him through how significant the depreciation is. And this guy just kept saying, he's getting it anyway. And finally I had to be like, sir, your client's 82 years old. Like, he doesn't need a write-off when he's 126. Like, let's get the money now. And so it's pretty fun to sit in the industry and just hear story after story. But I did talk about the bonus. The other thing I want to talk about is how that depreciation gets used for somebody who gets a cost seg study. So you get a cost seg study. How exactly does this benefit for you? Now, the easy answer is like, hey, if you've got passive income coming in, if you've got cap gains on a real estate sale, you're going to use that depreciation to knock that out. A great example is I had a client 2 days ago that I had coffee with. He is a home flipper. He doesn't do a whole lot of cost segs, but he just flipped 2 houses, made about $100,000 each, made about $200,000. And he's like, oh my God, this cap gains is going to suck. I'm going to pay like $45,000 when I go to file my taxes here in a couple of weeks. And I was like, well, do you have any long-term properties you're not flipping? And he's like, well, I got this amazing property in Gatlinburg, Tennessee that I Airbnb. I bought for $1.2 million. I'll never get rid of that. That thing's amazing. And so I was like, well, let's cost seg that. We got him a write-off for like $300K. He is now going to completely avoid all his cap gains, and he won't have to send that check for $45,000 to the IRS. Now, that's how you knock out passive gains. The next question is, can you knock out active income? And the easiest question to ask is, are you a real estate professional? If you're a real estate professional, then yes. If you're a real estate agent, and those guys have been making money for the last couple of years, let's say you made $300,000-$400,000 in 2022, and you're like, oh my God, I'm going to pay, or I have been paying payroll taxes. I'm going to pay all this tax. It's awful. But if you've got a bunch of real estate investments, let's say you've been buying property in syndication with guys like Dallin, you then get your K1 loss. Since you're a real estate professional, you can use that depreciation against your active income and avoid those taxes. I all the time have clients that ask me, how do I become a real estate professional? It's sort of easy and sort of hard. The amount of hours you need to do, that's easy. 750 hours in the world of real estate. Anyone who's buying property, anyone's got property, they're going to do 750. They're changing light bulbs. They're doing research. They're going to networking events. You're going to do the 12, 14 hours a week. That's not the hard part. The hard part, it's got to be the majority of your time. So you've got to do it the majority of, if you're a doctor or an attorney or an engineer, you can't convince the IRS you're doing 41 hours as a real estate professional and 40 hours at your other job. However, if your significant other is a real estate professional, when you file jointly, now you use all the depreciation to knock out the active income. And a great story I had for that is I had a client who, she has a bunch of property in the Vegas area. Hopefully she is not watching because this story is very funny. But she was like, I'm an attorney making like $800K a year. Can I take this depreciation and knock that out? You can knock out some active income when you make like 100K to up to 150. But once you start making this $800, $300, $400,000 range, you can't use the depreciation in that range. However, I was like, well, what does your husband do? She's like, the husband, this guy's just eye candy. I mean, I just married some 8-pack cutie that sits by my pool and does nothing. And I was like, all right, give this guy a job. This guy now manages your properties. You're gonna make him a manager of your property. He is going to log these hours, and we're gonna make him look into that. And then boom, by the next year, they had logged all the hours. They were filing him as a real estate professional, and she's knocking out active income with all her real estate purchases. And then it becomes a no-brainer, because then when you're looking at penciling a deal and you're like, oh, this one's so close. But when you start considering how much you're going to write off, you're like, we got to do it. Neil Bawa, who I had the privilege of meeting once, told me the story about how in like 2010, 2011, when the market's crashing, people kept coming and go, don't buy that property, man. You can't buy that. That property's going downhill. And he would be like, I just need the write-off. I don't even care. I don't even care about the profit, right? I don't need the cash flow. I just need to shelter more of my taxes in the tech industry. All right, let's see what some of these chats are real quick. And anybody else want to dive in, feel free.
There's a really good question from L, Tyler,
Yep.
if you want to chime in and jump on
Yeah,
that.
so he says, just to clarify, this can be used retroactively if the depreciation was never used for a property that's been owned and rented for several years. So absolutely. So if you've got a property, I have people all the time that find out about this now watching a podcast and they go, oh my God, I've got 5 rental units. Why have I never done this? I have real estate agents that call me and go, I just found out that Jason in my firm just sheltered all of his taxes and I own 4 properties. Why haven't I done this? You can. Now, the question is, how long ago did you buy the properties? Because if you bought them 27 years ago, you've depreciated everything. If you bought them in 2009, I always kind of wince a little bit because people call me all the time. And I go, I bought 5 properties in 2009. And I go, and I look at them and they bought them for $38,000 each, and in a short sale. And I go, well, there's not a lot to depreciate on that either. However, if you bought a property, in like 2018, 2019, heck, if you bought a property in 2010, we can take a look at it and pull that depreciation. You just have to file a 3115, which is just telling the IRS what Justin was saying. Like, this is how we were supposed to do it. This is what we wanted to do the whole time. And then we just play catch up and you get your big write-off in this year. And sometimes a great example is I had a client who is selling a home now. So he's selling a home in 2023. He's got this huge cap gain that he's worried about. However, he did buy a property in 2022 that he's keeping. And so we're depreciating the property in 2022. He'll use some of that depreciation, but the depreciation he's not going to use rolls forward indefinitely. So all that depreciation he doesn't take advantage of in 2022 is going to be there for him in 2023. And he can try to wipe out all of his cap gains that way. Let's see. Have you sent us some? Oh, thank you, Justin.
To that question, was there any specifics you wanted to ask Tyler while we have him and Justin on the line with us?
No, that's okay. I just want to know it's okay.
Okay, excellent. Just wanted to make sure.
Okay.
Yeah, feel free. Send me a text. I'll put together some free estimates on all the properties and we can give you a look at it. And sometimes, my favorite thing to tell clients is no. Like I love to tell clients like, this isn't going to work. A great example is I had a client 4 years ago, call me up and was like, hey, I've got all these Rust Belt. I'm a Burr method guy. I've got all these Rust Belt properties I'm buying for like $60,000 a pop. I heard about cost seg. I want to cost seg them. And I kind of broke down how the money he's generating on those properties is basically going to get knocked out by the depreciation he was kind of getting anyway. And it just wouldn't work, and I just was like, hey, I love the fact that you've got my cell phone. I don't think these are going to work for cost seg. However, nobody gets into real estate and says, I'm here to make a little bit of money for a little bit of time. Everybody tries to ramp up and make more and more money. That guy's now in multifamily and doing very well. And he called me up like 2 years later and was like, I've got 2 massive properties. Let's get going. So, give me a call. I'd love to put together an estimate. If it works, it works. If it doesn't, it doesn't.
Yeah, incredible stuff. It's such a powerful tool that a lot of people they don't know about it unless they're actively educating and pursuing in the space. Bruce, have you and your team have any personal experiences with cost seg that you could share?
We're doing one right now with, we're just going to get started with Tyler on a couple of them. We have not done them previously, but we're going to do them on the properties we own right now. And so we're, I think he's just waiting for us to pay him so he can get started. I don't know. I told him do it first. We'll pay him on results, but I don't know if that works. He wants to get paid up. No, I'm teasing. But one comment I wanted to make is that the reason the IRS encourages you to do the cost seg is they don't know what's in your building. You know what's in your building. They expect you as a sophisticated investor to go in and say, okay, I've got all these things that are going to depreciate. I got carpeting, I got doors. I've got, you can break it down as little as you want, but things wear out at different levels, but they have no idea what's in your structure. They know what's on your tax return. So when I talked to Tyler, he just opened my eyes to, hey, these things depreciate at different levels, and bonus depreciation aside, there's also the other just things depreciate. Not everything depreciates at, 27 and a half years or whatever it is. So the thing to know is just look at it this way, that you know what's in your building, you alert the IRS what's in your building and how you're going to depreciate it, and they approve it. And it's a great way to get tomorrow's money in your bank account today, as opposed to waiting till tomorrow to get it. So that's how I see it. And if I'm in error on any of that, Tyler, correct me, but that's how I see the cost seg in a very simple look.
No, that's dead on. I kind of mentioned that roof example is one of the best, but the IRS would prefer that you had very sophisticated and very highly paid engineers categorize everything. That's why when there are audits, which again, audits in general, very rare. Audits in real estate and cost seg are extremely rare, but I've now personally been through two. I have friends that work in this industry that have been through a few more. And every time the conversations have been so smooth, because the agent just gets to the cost seg part and is like, all right, let's move on. Like, they're not going to spend the next few weeks arguing out 180 different categories of items that are all broken down under the expertise of somebody in the field of engineering and construction. They're not going to argue what the square footage of drywall really was, so they might get into arguments of land value, but it's audits are incredibly rare and very easy. Let's see here. Can a cost seg, Jared's asking, can a cost seg be used to offset taxes on a W-2 or only income from real estate assets? Okay, so I kind of was talking a little bit about this, but just to recap it and explain it again, so right off the bat, and it really depends on what your W-2 is, but let's just say you are like a software engineer, okay? And you make $100,000 a year, you can use the depreciation from your real estate cost seg study to knock out $25,000 of that W-2, right? Like that. So right now you've dropped from a $100,000 tax bracket down to a $75,000 tax bracket, and you're paying, and then you start using your tax credits and everything else off of it. And Justin can kind of back me up on this, but this is my understanding, is then you use all your tax credits like child tax credit, married, everything else off the 75, and you begin to push that down even further. But off of a W-2, if you make 100,000 or less, you can use 25,000 of your depreciation off that income. Anything you don't use rolls forward indefinitely. So if you did a cost seg on a $500,000 property and got a $90,000 write-off, you for the next 3 years could avoid a good $25,000 of taxes or of taxable income, which would translate to, $7,000 to $10,000 of taxes. But you could avoid that every single year for the next couple of years. If you make up to 150, that slowly declines. It goes from 25,000 down to zero at 150. So every $2 drops $1 off. So by the time you get to 150, now you can't, if you're making $150,000 a year in your W-2, you now can no longer take that depreciation off your income. However, if you or your spouse is a real estate professional, you now can attack the W-2 income again. So a great example is if you make $150,000, make $200,000 a year as a software engineer, but your husband is a real estate agent or a property manager, or has quit their job to focus solely on the multifamily properties that you guys are investing in, or the Burr method property. Once you get to about 10 properties or so, you start thinking, hey, hon, it would be way better if you actually, say the husband was like a teacher making $50,000 a year. You just go, hey, honey, this would be better if you just stayed home with the kids. We save on daycare. you then take 20 hours a week to manage our properties, because then we can take all the depreciation from all those real estate assets and actually knock out the active income that I'm making at $200,000 a year, and I'll shelter $75,000 in taxes. So the fact is, like, we'll actually shelter more in taxes on the $200,000 in income than you're making as a teacher at $50,000 a year. So that's another way to do it. Would you agree, Justin?
Yeah, that was an excellent question, Jared. And because that's what a lot of people are asking. So a couple situations or scenarios. My wife's a registered nurse. I'm a real estate professional. We file our taxes jointly. Collectively, we haven't paid taxes in 3 years. And all that money that was getting pulled from her check from the hospital came right back to us at the end of the year. So we showed last year we showed it. I didn't even know this was a thing before I started getting into business. I remember my father telling me he had a negative return. He had a loss on his tax return, and I couldn't comprehend it until I personally went through it. Last year I showed a negative $52,000 loss on my tax return, and all that money that was taken from my wife's check automatically was returned back to us. So not only did we experience that loss, but we got probably the biggest tax return I've ever gotten back in my life. So it was kind of it's just interesting. Another example, higher level, there's another active operator I know doing similar things that we are. Her husband is a high paying attorney, high income earning attorney, probably making $400,000 or $500,000 a year. All because of her active role in real estate and how involved she is. They're not paying anything on his $400,000 to $500,000 a year that he's making from his W-2. So, Jared, quick answer or response to that is, if your spouse is open to it, maybe it's a good time to have that conversation, because that's going to enable you to get the most benefit out of it sooner than later. So, and listen, we had when we had Justin on a few weeks back, a couple months ago, we recorded that as well. It's on our YouTube channel. He goes into depth on the real estate professional. So he did include a PDF in the chat box here. If all of you on the call haven't had a chance to download that, do it. Download it and then refer back to that video on our YouTube, because Justin really gets into more detail on how and when you can maximize that depreciation, whether you're a real estate professional or not. So awesome question, Jared.
Perfect. I think that about sums it up on my end. Is there anything else? Any other questions? Let me see. Chat. No. All right. Anything else you were thinking, Dallin, I should have covered that you think might come into play?
Probably, but nothing that I could think of off the top of my head.
Yeah, the only
was
thing
excellent.
I'm thinking
Justin,
now is, real quick, sorry. The only thing I was going to say too is, remember the sunset rule. If you're looking at property and you're like, hey, I'm going to buy this property in maybe December or January at the end of this year, and you can throw a couple bucks under the table to your broker to get that thing closed in December of 2023 instead of January 2024, make sure you get that done. Because in 2024, it's going to drop to 60% bonus. So that means, like, on a $500,000 property that in 2022, you got a $100,000 write-off. In 2023, you're going to get a $80,000 write-off. In 2024, it's a $60,000 write-off year one.
Excellent. One thing I want to point out too, because we get this question a lot. If you're participating in a syndication, if you're participating in a fund as a passive investor, do you still get to experience this? And the simple answer is yes. And that is displayed through your K1. So when you invest into a syndication or a fund into that entity, they're going to be doing a tax return. And when you buy membership units in that, you're coming in as a partner. And so you're going to you'll be able to capitalize on that depreciation, and it's going to pass through into a K1, which then you take to your CPA and say, hey, I have this investment deal. Here's a K1. If that K1 shows a negative $20,000 loss, then your CPA will plug that into your overall tax return. So I just wanted to bring that up because that's a question that gets asked quite a bit.
And a great example of that is, because I have clients all the time that when they do syndication, it's an easy pitch because you go to somebody who's making, let's say $100,000 a year, and you go, and they've got some money saved up and think about getting real estate. And you say, hey, you give me $25,000 into an investment, we're going to try and, 2X that over the course of the next couple of years. We're going to try to get you some money, coming back in passive income. But remember, you're going to get a K1 loss around $25,000. And if you get that, you just write that right off that taxable income of 100,000 and you just saved 10,000 grand, 10,000 bucks. Now you've really only invested 15 grand into an investment that hopefully might get you $50,000 back at the end of the run.
One comment I wanted to make real quick too. So Tyler talked about how 2022 was the last year for 100% bonus depreciation. Now it's dropping to 80. Just to clarify, you're not losing that depreciation. It's just determining how much you can take up front.
Yeah.
So it doesn't go away. It's just you're able to claim it at a different time.
Yeah, thank you. And to put that into some perspective, you know how everyone's now trying to readjust their thinking when they start thinking of like what the interest is going to be on a purchase, and people like, 6%. Oh my God, I would never buy a house at 6%. You go, we did 6% for 20 years. Like you can buy a house at 6%, and they try to expand. The same thing in the world of cost segregation. Some people are like, oh my God, 80%. And you go, dude, for years, people did it just because it boosted the 5 and the 15-year property. People just did it because you got a bigger run for the next 5 years or so because you put stuff in those faster depreciating buckets. The fact that you still get an 80% depreciation is awesome. So 80% is great, 60% is great. And then, like I said, typically because you're getting 80%, 20% of that bonus stays in the 5 and 15. So of, let's say the 100,000 that we're putting in 5 and 15 on a $500,000 purchase, it stays in that 5. 80% will be your bonus. 20% gets dropped in the 5 and 15. Then you add that to what was left on the 27 and a half year. That means for the next 5 years, you kind of get the same write-off that you would have got if you didn't even do a cost seg study. So not only do you get the benefit of the cost seg study in year one, but you almost don't see any negative for the next 5 years. It only starts to depreciate a little bit more after 5 and then after 15.
Yeah, I was going to mention that when Dallin was speaking, that the cost seg makes sense even without the bonus depreciation. In most cases, the bonus depreciation is just that it's a bonus. But I don't look at it as a deterrent. Say, well, I was going to do it, but now we only get 80% bonus depreciation. Well, there's other benefits to cost seg. Cost seg's been around longer than bonus depreciation, and will continue to be around for longer. So it's a way for you to properly segregate and depreciate your property. So to me it's good business. So look at it that way, and the bonus is just that, a bonus during our current tax benefits.
Yeah, and another example you kind of mentioned is like, because then when you go in and you go on a monthly rental, let's say you're swapping that carpet out every 2 years, like every 2 years or so, you move your monthly rental out person, you start a new lease with somebody else. The good news is you can go where the carpet is depreciated. You can see that you bonused it in, let's say 2022, but you know where that line is. You know how many, it's a 5-year asset. You know how much you just spent in carpet. You drop it back on that line. You look at the year, say 2024 in this case, and you take 60% of it in the first year and you leave the rest in a 5-year run. It kind of helps you depreciate everything else moving forward.
Awesome stuff. Justin, was there any thoughts that you wanted to add?
Yeah, actually, I want to build off of something that you and Tyler were both saying. Because you mentioned here in 2023, the bonus depreciation is 80, and Tyler, you were saying if you're going to close on something in December or in January of 24, see if you can't close on in 23 because the year that you purchase the property, the rule will apply. So you still want the 80% bonus depreciation. Well, the good news is, and somebody had asked the question, and I forget who, that can you do this on properties that you've already owned for a few years? And the answer is yes. And the answer to that is also that if I do the cost segregation now in 2023, the 2023 rules don't apply. The rules will apply the year that you purchased the property. So if I bought a property in 2020, I'll still get 100% bonus depreciation, even though in 2023 the rule is now 80%. If I buy it in 80%. So there's no reason to not do it. I like how that was being said earlier.
And then another example too is in 2016, if you bought the property and there wasn't any bonus, but you're doing it in 2023, because you have to file your 3115 and play catch up, you're going to take all of the 5-year assets that you should have been taking since 2016. You get all that in 2023. Then you take more than a third of all the 2015, boom, right in 2023. So when you play catch up, you still get a huge write-off because you're playing catch up from a property in 2016, 2015, that type of thing. Kind of same thing you said.
Excellent.
Good stuff. Well, any other questions before we wrap this up?
One more thing while people type it in the chat. The other thing that I hear all the time, the biggest misnomer, I hear a lot of stuff about cost seg. The two biggest myths I hear is you have to do it in the year you bought the property, which we've already now shown that's a myth. People all the time go, oh, I would have done a cost seg in 2021, but I missed out on that opportunity. That's not a thing. The other one I hear all the time is you have to buy a $2 million building or more. I hear that it's got to be $2 million or more before you can do a cost seg. That is absolutely not true. I hear people doing Burr method houses in the Rust Belt, under $100,000. I've had clients that actually kind of funny. I had a client recently call me up. They had 17 properties in Texas. They were all like between $100,000 and $200,000. And as I'm looking these up, I remember thinking, these are going to be just dumps, right? Like these are going to be awful houses. They're all brand new builds in Texas. And I was like, oh, leave it to Texas. We get so spoiled when you look at houses in like Scottsdale and Southern California and stuff. But you can even bonus houses that are in the $200,000 range. So there's a place for cost seg for everybody in this kind of modern era of bonus depreciation.
Awesome. Tyler, thank you so much. Thanks so much for the information, Justin, as well, and Bruce for your comments. It's an exciting space. Real estate is an exciting space, and there's always going to be opportunities and benefits for people to get involved. There has been 100 years ago, and there's going to be 100 years from now. Because at the end of the day, and why we like multifamily at Rev, is that you're providing a basic human need. You're providing shelter, and these tax benefits and incentives allow you to reinvest into the communities and the buildings and the people that you're serving, if done properly. So it's a very powerful tool that everyone getting involved, whether you're passively investing or actively investing, can benefit from. So listen, I appreciate you all tuning in today, and staying tuned for the next webinar next week. So this recording will be going out Tuesday morning. It can also be found on our YouTube channel. And I would recommend, if cost segregation is something that you're seriously considering, which it should be, if you haven't gotten that from this webinar, you definitely should be, to also go back and watch the webinar we had with Justin, as he was diving into the qualifications of a real estate professional and really how to maximize on the tax benefits. Because having a good CPA and a good cost seg company, that's where you're going to get the most benefit from this aspect of it. So appreciate you all tuning in, and we'll see you on the next episode.